Yeah, good day trader. Welcome to my YouTube channel. So on this channel today, we'll be speaking more on our current topic whereby we are dealing with in our series, which is called the principle of fair value gap. So whereby in the episode 3, um, I talked about the, um, the strategy or the full step whereby we can make use of fair value gap with. Like we can use fair value gap with. But today I'll be showing more example on how we can be able to trade or force a pattern into the fair value gap concept. How you can be able to put a pattern into a fair value gap concept. Or today's is just to show you what was taught in our last video whereby I talked about stop on break of market structure and then the fair value gap. So today I just want to show you more example whereby a trade on gold that we trade live and we use that same concept and it works. So I just want to show you how the breakdown of everything, how it works um and the results. So this is to show you that um you don't need to trade fair value gap for fair value gap concept. You don't need to trade fair value gap because it is fair value gap. There are things you have to add to it. There are things you have to build your strategy on the fair value gap concept. So when you are building a strategy on a concept, what it means is that you have to understand the market full step. The market full step has to be understood or understand by you on the concept. So this is fair value gap. We are talking about the fair value gap. I have explained in the episode 1 about what really is fair value gap, and I have talked about why market should obey the fair value gap. Okay, let us first and do a little recap on what I taught in last video. I said if you have market high way, the market traded high again, it took out the stop ons, the market break the structure. So this is what we talked about last week on our last video. We talked about this and this. So which means that market took out the stop ons, market break the structure, then I want to look for fair value gap as my POI. So POI means the point of interest, the point whereby I want market to actually sell from. So which means that I am not selling because it is fair value gap. I am selling because I have already seen some market full step in my chart already. Then the fair value gap is just an entry pattern, just an entry zone whereby I can enter from a pot. Some people call it a PD array. So it is called a PD array. Like that's a particular zone whereby you want market to reverse from. You can use other block, you can use breaker block, you can use but today in this video we are talking about the fair value gap. So how you can be so confidently sure that market is going to retrace from this particular zone. So let's dig deep into the video and so we can look at the example in a very straightforward manner. Okay, this is good here. I'm looking at good charts. I'm looking at Monday, July 9. Okay, yeah, this is July 9. Okay, this is July 8. Yeah, Monday, July 8. So looking like it's not doing anything, right? So let's go into the market. So don't forget our pattern, stop on break of market structure, then so market break the structure here, market trade down, the market it trades back into the range. So you can see how market it trades back into the range. So I was expecting market to come down and break this low, then the market come down there and take this liquidity above here. So number one is that I have a liquidity taken out and market took out the liquidity, then it goes down. Then number two, I have a break of market structure. So I have my two formula intact. So which means that the third formula is the fair value gap, or this is what is going to put everything into a one masterclass strategy. So which means that I will not be a trader. I will not be trading in the market without having a fair value gap, even if these two occur. So which means that if I'm having my break of market structure, so if I'm having my break of market structure, I'm having my BOS and I have my stop ons, I will not be trading if there is no fair value gap. That's just it. I will not be a trader if there is no fair value gap. So that is what you have to understand first. I will not, because it is not complete. The formula is stop on first. So when you see a stop on, market took out a liquidity from here. This is a major high because it retraced into the range and it was supposed to go down. The market goes up again and took out the liquidity. Then market breaks the structure, the low that created the high. Automatically, when market breaks the structure, I have two things: stop on and break of market structure. So which means it remains the fair value gap. So we have our fair value gap here. Okay, let me try and zoom out now. Okay, we have our fair value gap here. So don't forget what I said the other day too. I said your fair value gap has to be inside your premium zone if you are trading for sale. It has to be, if you are trading for buy, it has to be in your discount. So yeah, this is a premium. Yes, that's why I choose the fair value gap. Don't forget, there is two fair value gap there. We have this upper one and we have this one. You see this one here is inside there. This is the 50%. So which means that the open of the fair value gap. Let me zoom very very so you can see it here. So you can see this first fair value gap here. This first one. The open of this fair value gap is in the what? Is in a discount. And I'm looking for the fair value gap in the premium because I actually want to sell, because market breaks the structure down and market comes to a lower prices. So I want market to retrace back to a premium price. At least it should pass the 50% level, the equilibrium. So when market pass the equilibrium level, I want to see a particular zone whereby I can trade from in the premium, so I can follow up with the market. So it will not be wise of me to take a trade in the discount, whereby market actually come from a premium to a discount, and I'll be taking trade from a discount. So which means that that's why we choose the upper one, because this one is inside the premium. I hope you understand. So that's the reason why this was chosen. And don't forget, the major analysis here is that we are trading the internal range with liquidity. The internal range liquidity here is the fair value gap. We are trading to the external. The external is the sell stop that is here. So if my entry is here and I put my stop loss somewhere near, because I don't want my stop loss to be big. So somewhere near, then I put my take profit here. So 1 to 2. Don't forget, I usually target 1 to 2. That's just myself. I don't, you can be able to hold and hold and hold. But as for myself, 1 to 2 is okay for me. And sometimes I can lower my stop loss. So if I lower my stop loss, at least this is my target. I'm not picking long target, just the target at the external range liquidity. So let's see how it works. So you can see it here, market enters into it, and you can see the sharp sell. You can see the sharp sell when market enters into it. So this is the complete sector. It is called the stop ons plus break of market structure plus fair value gap. So let me show you inside my Telegram channel. So this is my Telegram channel. You can see the trade here, gold sell limit. So you can see the gold sell limit. So this is it here. You can see it was traded. Okay, let me click on it. So you can see it was traded, and so you can see it was traded. So this is the gold trade here. So don't forget to like, share, and subscribe. So I think, okay, let me show you. I think we had take profit. Okay, I think we have, so you can see there when market was going, when market enter into it, you can see 100 pips. The market took out market move 100 pips. So you can see this is traded live, and it was shown to the Telegram channel members, like no hide and seek. So you can see the market was trading bearish. So I'm just telling you that the the strategy is actually correct, and it's very trustworthy. You can trade it. So this is it here. You can see the whole trade market enter into the fair value gap, and it comes down and comes to our take profit, and that is 140 pips. So you can know just by knowing, just an understanding that you have 140 pips from the market. So there is even still more example that occurred just during this time, just during this time phase, whereby we have a lot of fair value gap trade, whereby I saw and I took this trade. So if you look in depth here, you can see a fair value gap here also in market. You trade there, and so this is how you can be able to use fair value gap. So I'm just this series is just trying to tell us that it's trying to show you the dynamic power of fair value gap. It's trying to show you the how essential, or how market makers obey the fair value gap. And in um the episode one, I explained the fact that why fair value gap needs to be obeyed. And so you can watch if you episode one to understand a lot of things about fair value gap. But you can't trade a fair value gap just because it is a fair value gap. So you have to put this in mind, that you have to trade a fair value gap as a PDRA or as a POI. So don't trade a fair value gap because it is a fair value gap. So don't forget to like, share, and subscribe. More videos are coming, and don't forget to comment on, okay, these are the things you want us to work on. These are the things you want us to do, or encourage the team also, so that we can do more video for you and we can study all together. And if you want to join my Telegram channel, the link is in the description. Don't forget to click on it and join. It is for free. I drop insights, and you can see, and sometimes signals also, so that you can trade also. So thank you very much.